In this episode, I'm going to talk about which companies you should avoid in a recession. I will also talk about some companies you should avoid, nevertheless, in good times and bad times. So recently, there's been a lot of talk about that we might be entering a recession. Now, that can be scary, and it has created some, a market dip of some sort, and a sensation of, what's going to happen? But it's really important to keep investing throughout a recession or a market dip or whatever we are going to go through, because that's where you will create the foundation of your future wealth. So let's dive into it. Which companies should you avoid in a recession? Welcome to Money and Freedom, the podcast where you learn to become financially free using value investing. Warren Buffett says that there are two rules of investing. One is to never lose money, and the second rule is never to forget rule number one. And that is really such an easy thing to say. What does it really mean? Well, it really means that you should never invest in something that will go bankrupt. And that is something there's a higher risk of in a recession. That's why people get scared, because a lot of things will change if there's a real recession. Some companies will get into trouble. It's like a huge cleanup in the market. Some companies just won't make it. But the companies that do make it, they will stand so much stronger because the competition is gone. Some of the competition, at least. What should you avoid? And I say there are 5 types of companies that you should avoid. First of all, companies that do not have a turnover, that do not have any revenue. Okay, so you might be thinking, that's a no-brainer. Why would you invest in something that doesn't make money at all? Well, I will tell you that there are a lot of people who invest in things that do not even sell anything. Why? Why does this happen? Well, they invest in a dream, really. When people invest in the newest biotech company, they're investing in a dream. And it happens a lot, especially where I'm from, where we have a strong both pharmaceutical and biotech industry. Denmark, I'm from Denmark, if you don't know that. So it happens that people hear about this company, then they're going to create something. They're going to invent or create a drug that will solve a huge problem. Some kind of cancer that affected somebody in your family, and you get so passionate about it that you invest even though they didn't invent it yet. So they're working on it, it's in the pipeline, it's promising. And these CEOs, they're like salesmen sometimes, they can really talk it up. And it sounds like, not only does it sound promising, there's a huge market because everyone wants to live longer, right? It also sounds like a good thing to do, but don't. Do not do it. If the company doesn't have any product on the market, it probably won't survive a recession. That's just how it is. Maybe you're thinking, I don't invest in biotech. Maybe this isn't me. Well, actually, there's a lot of other companies, and a lot of people just forget to look at the numbers. They don't even open the 10K. They have no idea what they invested in. There was another case of, if you remember, there was a time when these cannabis companies were really hot, and everyone believed, it's getting legalized, it's going to be such a huge industry, how exciting. Well, I remember there was a lot of hype of a particular company in Denmark that was going to sell something cannabis, something. And everyone was talking about it, and I looked at the number. I'm like, there's no revenue. And I actually called them up. It's not a very big company. So I just got the CEO on the line. I'm like, there's no revenue. Did it change? Do you have? No. We're developing. So this wasn't called a biotech company, but it was a company that wasn't selling anything yet. They were selling a dream to the investors. And you know what happened? It went bankrupt. Not fun for the investors. So, another thing about this, it's not just that the CEO can be really good salesman. It's also that some of these companies, they get listed on the stock exchange. They have an IPO, initial public offering. And around that initial public offering, there's a whole team. It's really, really expensive to get listed on the stock. So there's a whole team of really professional people that will sell a story. And it sounds so enticing. Okay, bottom line, no product on the market, no sales, don't invest. The second category is company that lose money. So now we have a product on the market, but they don't have a profit yet. And a lot of people invest in things that they do sell something, but they haven't made it into a profit yet. And to be quite honest, it could be a good investment later on, because some companies, they will invest heavily in the future, and that's why they don't have a profit. This happened with Amazon for many, many years. They were investing really, really heavily in the future. And now they do have a profit, and that's great, and it's been a fantastic investment. But as a private investor, it's probably going to be pretty hard for you to know if this is the case of a company that do not have a profit, that do not make money on the bottom line on purpose, or if they're just really bad at making money. It's really hard to tell the difference. So it's safer to stay out of companies that do not make a profit, that do not, whether you talk about the top line and the bottom line, where the bottom line isn't green. Just stay away. The third category is cyclical companies. These are companies that will be hit harder than other companies in a recession. And why are they hit harder? Well, because it's some kind of category that people spend less money on if there's a general downturn in the economy. Anything related to transport or travel is very, very cyclical. So anything that related to cars, that's even if it's wheels or whatever's inside the car, bad idea. Or travel agency, anything related to travel, even to logistics. Also, things related to construction and property development. What happens is, if people are fired or even just afraid of being fired, there are some huge costs that they will avoid. They might just postpone it. You don't buy a new car if you're afraid that you might get fired. You don't go on a huge luxury trip if you're afraid you might get fired. You probably don't buy a new house. You might downsize, but you're not going to upsize. You're not going to buy a lot of furniture either. So these are things that we want to just stay away from when we are entering a recession. When we are exiting a recession, it's a great idea to invest in them. Every time there's a recession, there will be a wave of problems with these companies. We've seen it over and over again with the huge car manufacturers that some of them go bankrupt every time there's a recession. The airline companies. So avoid these. You can invest in them later on. The fourth category is companies with a lot of debt. Companies that are burdened by a high level of debt, they will be at a higher risk of folding when there's a recession. You can compare this with people. So let's say you have two people. You have someone who does not have debt or hardly any debt. And then you have someone who has student debt, credit card, mortgage, all of these things. Both of these people get fired. And they have the same thing. They have, their car, house, and so on. Who is going to be able to stay in the house? Well, probably the one with very little or no debt. The other one will probably have to sell if he or she doesn't get a job after a while. Because the person has no income and a lot of debt that has to be serviced. It's the same with companies. The ones who make it are the ones with lower debt. That's why we really like companies with low debt, especially when we're entering recession. So how much debt is a lot and how much is little. There's a rule of thumb. We would like the companies to be able to pay off their long-term debt with 3 years of free cash flow. Now, this isn't very hard to figure out. Most companies will actually tell you what their free cash flow is in the 10K, in the annual report. If they don't, you can download my ebook and figure out how to calculate it. And definitely they will tell you what the long-term debt is. That is on the balance sheet. The fifth category is companies whose product you don't understand. A lot of private investors invest in things they don't really understand. They think they understand it. They heard the story about it. There's such a huge difference between investing in something you really understand and investing in the dream that have been sold to you. Especially when we're entering a recession, it's important that you know what it is this company is selling. And how do you know? Well, ideally, if you can see the product, if you can go to a shop and look at it and see it's really here, that would help a lot. That's harder with a service. Now, why is this important? Well, some companies, we have had cases of that. For example, in Denmark with the ET factory, which was, it was, it wasn't there. Whatever they said they were selling, it just wasn't there. It was a lie. And it was fiction. And you do not want to invest in something where either the whole thing is fiction or part of it is fiction or it's pumped up. It's really hard to get a feeling for how real things are if you don't understand the product. So that's really, not just understanding the product, figure out if you actually like the product. So I, within the last 6 months, I invested, not a lot, but a little bit in Lululemon. And there's no shop around here where I am, so I ordered online a lot of Lululemon clothes to see, do I like this stuff? Does it feel good? Does it shrink when I wash it? How is it? So that's what I do when I invest. I will go out and investigate, actually. And, I used to be a journalist by training, so I think of it as an investigation when I am investing. Those were the 5 types of companies to avoid up to a recession, before recession. So there are also some companies that I would say, as a private investor, you probably just don't want to do it. One is financial companies. The annual report of financial companies is really different from the way other companies report. And it can be really hard to figure it out as a private investor. And also, it's very hard to see what's actually on the books. That's what we learned during the financial crisis. And that's why I just don't do it. Just stay away from financial companies as a private investor with the limited resources of researching. The other one is biotech and pharmaceuticals. We touched upon that a little bit when we talked about companies with no product on the market. That could be a biotech company. Now, pharmaceuticals, we usually have products on the market. So what's the problem there? If you can see they're selling something and they're making a profit, well, it's like the little ticking time bombs with pharmaceuticals. They will have a product and other companies will have something in the pipeline that might make that product irrelevant. So, and you also have the company that you're investing in will also have things in the pipeline and the speculation, this is going to be great. There's a little bit of biotech in every pharmaceutical, right? Because there will be the story of what's coming and the hope attached to that. So that's one unknown is whatever they have in the pipeline. Pipeline is just a word for the products that are in the process of being developed. Whatever's in the pipeline there's so many unknowns. Like you cannot know it. It's like products you don't understand. So let's say you really do understand it. Like you are a scientist, you really know what's in the pipeline. Well, fine. But what about the other company's pipeline? Do you know what's going on there? And the other companies, like I just said, they can have things that will completely make what's in your company irrelevant. Let's say the company you want to invest in, they have some kind of medicine that you have to inject. And it's a fantastic medicine. It's the biggest on the market. Everyone loves it. That's great. But let's say someone else invents a pill you can take once a month. So the needles are no longer necessary. Who wants to put a needle in themselves if they can just take a pill, even just once a day? It's so much easier, right? No one loves needles. Well, that will make that product irrelevant, the product, but the needle irrelevant. And the third one that you should avoid is ADRs, American Depository Receipts, especially if it's a Chinese company. So what is that? So it means when you buy stocks on the American Stock Exchange, but it's actually of a company in a different country that's listed on a different country. So it's issued by a U.S. bank, and it corresponds to shares in a different company. Why is that a problem, especially with Chinese companies? Well, because of the trade war and the strains in the relationship. What if the Chinese government, and they would do, it's a communist society, so things have their own logic. What if they said those shares no longer count? What if they're just nulled, deleted from the system? Will it happen? Probably not. Could it happen? Yeah, it could. So just don't. If you really want to invest in Chinese, and I would be really careful with investing in China, I would buy it on the Hong Kong exchange and not through ADRs. So those were the three companies to avoid at all costs, and the 5 companies to avoid before recession. Now, you might have a question. So how do I invest if there's a recession? What should I do? What am I going to do? Well, a few pointers here. First of all, it's really great to have a buffer of cash. Cash is gold, right? Before a recession. So cash, how much? Well, first of all, you want some cash that are meant to make you feel safe. So have an emergency account and also an F account. And the F stands for the word I cannot say because it's a swear word. And that's because you're going to say F and leave. Okay, first of all, the emergency account. So have enough for any major repairs. I would say somewhere between $3,000 and $10,000 euros, doesn't matter. Something like if your car breaks down, you really have to fix it, or something happens. You have to take a plane to South America because your brother is stuck there and you need to help him, whatever, that kind of expense. Then you need the F account, which the F is the secret word, cannot say it, children on the line, where you can say, well, I'm going to leave this company or leave this job. So you need to have at least 3 months of salary. I would say 6 would be much better. So whatever that is for you, have that ready. Why? Why would you not just invest everything you have? That's what, people always say, just invest everything so you get the most out of it. Well, the purpose of the money that we're setting aside here is to make you feel safe so you won't sell anything in panic. And that is worth a lot. What else should you do? Well, try to invest in something that you know that people always need, something simple that they definitely need it, and they will buy it. What happens is in a recession, it's not like people stop spending money. There are some things that they will spend even more on. They won't buy the new car, and they will not go on the big trip, but they will definitely still have, for example, this is just an example I just invented, they will still have that Netflix account. It's not like they're going to be like, they will still buy food, and they might spoil themselves a bit more at home if they're not getting that trip abroad. So look for those kinds of products. And make it a product, of course, that is easy to understand. We talked about that just before. And of course, as we talked about, low debt, make it a company with low debt, and a solid management that you trust. And then, of course, always take your company through a checklist. You really have to make sure you know what you're invested in. And the idea of a checklist is to help you make sure you go through all the points. It's to help you make sure that you're making the best decision, that you're making a conscious choice of what you want in life. This is actually something I've been thinking a lot about recently, that not just with investing, but with everything in life, things will come at us, opportunities, friends, parties, job offers. And how do we know what to say yes to and what to say no to? Well, you need to have some kind of process, and you need to have, write down, what is it that I'm looking for? I really believe in writing down as well. Write down like this, the ideal company should have this, 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 and this. And maybe that's an idea for another podcast. What is the ideal company? If we could draw a picture of the perfect company, what would it look like? And those things that company should have and those things that it shouldn't have, we write that down in the checklist. So we make sure we make the best decision when investing our money and time, if it's something else. If you enjoyed this podcast, please like, review, and subscribe on your favorite podcast channel. It really helps the podcast grow. Do you have any question? Please hit me up on X or LinkedIn. My handle is my first name @Beile, spelled Beile.